I have a live audience of 2 in the studio. Hi, everybody. Adam Shapiro here. Talkenomics Live, coming at you from Brooklyn, New York, one of the largest boroughs in the tri-state area. Let's talk about what happened today, because I think a lot of people are still trying to catch their breath after losing their cookies earlier this week. That's why we're calling this episode Risky Business: Tariffs, Investing, Retirement. We're going to talk about riding the tariff tsunami. Today it was a fun ride. We're going to talk about investing. We've got the originators, the founders of a new nationwide exchange. It hasn't gotten approval yet from the SEC, but that could come this year. That's coming up in this hour of the program. We're also going to be talking about retirement, but not necessarily just your investments. But if you're a small business owner, a large business owner, we've got a guest who's an expert in creating the retirement plans that you need to help your employees. But we got to talk about these markets. Let's take a quick look at what made everybody go, say, what? The Dow. Up about 8% today, up 29. It was 2,962 points. You had the S&P 500 up 9.5%, 474 points. The NASDAQ was up. Are you sitting down for this one? Up 12%, 1,857 points. And can you imagine why? Because as the executive producer here, Taylor, pointed out, it wasn't as if this was unexpected. Donald Trump tweeted this morning, "Good time to buy." Now, we'll talk about the implications of that a little bit later on, because that tweet came at about, it wasn't a tweet, it was what do you call them on Truth Social? It's not a tweet. It's a truth. Okay, he truthed at 9:30, and you want to bet that some of the Trump offspring made some money today, along with a lot of other people. But here's the deal. A lot of people are breathing a sigh of relief right now. But can you breathe a sigh of relief? David Nelson is the chief strategist at Bell Point Asset Management. He's also a good friend of mine. He comes on the show periodically, and he saves my butt, and he's here to do that today. David, it's good to see you.
Hey, thanks for having me, Adam.
Okay, I got to ask you this, because we wrote an article at my other job, and we put in there, did President Trump blink? So I'm going to ask you, did the president blink when he basically put everybody on hold for 90 days except China?
I'm going to be diplomatic about this. I think what President Trump did, he listened to some of the adults in the room, like Scott Bessent, and I think Scott understood what most of us on Wall Street understood, was that the financial plumbing was starting to come undone, and he could cause a fair amount of damage here. So I think what he wanted to do, he saw what happened the other day when that rumor went out. Mm-hmm. There was a rumor that about this 90-day pause, because some had called for it, and he saw what that would do to the market. And I think he understood that the relief was needed, and he pulled the trigger, and he gave us that clue this morning. I wish I had heeded that advice.
It was lost on me until Taylor pointed out, Trump told everybody he was going to do this. But let me ask you about the financial plumbing, because today it was as if it's what happens when your 2.5-year-old throws a little doll into the toilet. It got clogged up. And the situation with Bessent, back in October, he talked about the need for tariffs and the need to bring asset prices down. So it's not as if he doesn't understand the consequences of tariffs, but did the Secretary of the Treasury, misunderstand how the world would react because they were selling treasuries? The flight was not to security. The Japanese were selling them. People were getting out of treasuries.
That was really it, I think, because Scott Bessent all along, this whole slide started when Wall Street started to understand that they weren't going to use the stock market as the barometer of success or failure. They were really looking at the bond market. And a lot of us had even thought that, well, they can get the stock market down, get the prospect of recession out there, get the yields down. We got over $6 trillion in treasuries that have to be refinanced this year. All of that made sense. And suddenly that whole trade started to unwind. That's the financial plumbing that I was referring to. And if the bond market started to roll over, that has much bigger implications than whether or not Apple goes up and down.
Okay, so we're going to be talking about that in just a second, but I want to remind everybody who's watching us on X, on YouTube, on LinkedIn, you can ask questions of the experts. You can ask questions of David. You can ask questions of all the people who will be joining us about what happens next, at least what do you expect to happen next. And we will not pull a Goldman Sachs. Goldman Sachs yesterday said we expect a recession. Only an analyst at Goldman Sachs can then, and they put it out this morning, we expect a recession, and then this afternoon, we revert back to our pre-decision, which was no recession. That's what you get when you're a seven-figure analyst at Goldman Sachs. But let's bring in a person who truly does understand fixed income. And this is a guest who we are gratefully appreciative to be here. This is Arthur Lafford Jr., host of a Macro Micro Moment that you can see every Wednesday at 5 o'clock, streaming on your favorite device. But he's also the president of Laffer Tengler Investments. And Arthur, you joined us at the last minute because you were just talking about all of this at 5 o'clock. So I appreciate your stepping in because we need to understand, and you have the expertise in fixed income, what actually happened. Because most of us who are not in the industry day to day, we don't pay attention necessarily to the bond market unless we're laddering bonds. But what happened? How can we explain this, say, to a 15-year-old?
A 15-year-old. I got a 17-year-old last one at home, so I don't know about that. But it's interesting, Adam. Thank you for having me on. David, nice to meet you too. You've seen spreads on 10-year treasuries move close to 100 basis points in 3 days, down then back up. And if people think that the whipsawing on equities is bad, this has been pretty serious for bond guys. I mean, this is like heart attack time. Interesting also is that credit spreads are doing something unusual as well. You see munis backing out, which you wouldn't expect to see. You're seeing high yield back up, but the investment grade, the corporate side, not so volatile. And it's interesting, if you want to reduce trade deficits, the way you finance trade deficits is when people are selling more stuff to us. We don't buy things.
Capital account.
Yeah.
You're talking about capital account. We don't talk about that in this discussion.
Yeah. They have to buy treasuries when they sell more stuff to us because we're paying them in dollars. We're not paying in pesos. So, one of the consequences of getting these trade deficits down might be that you see weaker auctions going forward. I'm not super optimistic of where the rate curve's going. I think that the more intermediate term rates are going to probably be higher than they are now.
David, jump in. Do you have a question for Arthur?
Yeah, Arthur, what I would like to ask here is all of this really started because of Trump's belief going all the way back. It's not really about what happened last week, last month, or even the election. He's really been looking at tariffs really since the 80s. And if you can take that all the way back really to Bretton Woods, 1944. And we've had a tariff system ever since then. Back then, the world order was that the United States was so strong, it was good to let other countries, tariff us a little bit more, help these war-torn economies. 80 years later, we're running debt and deficits pretty large. So it begs the question, is Trump right on this? Should something be done about the current system as it exists for the last, several decades?
Yeah. I guess like everything, it depends. I guess he's right in the sense that I think it's almost like a Doge issue, which is kind of interesting. Tariffs are really complicated. I mean, Larry Kudlow was talking about it. I was watching him. He said, I think Canada, the book that just has the list of tariffs, and it goes down to like frozen chicken parts versus the whole chicken under 6 pounds. I mean, it's crazy stuff. It's 1,400 pages just for Canada. And so if you want to simplify the system, the best way to do it is to try to basically get what effectively comes to a flat tax, because tariffs are taxes. If he can get the rate down to 10% or very close to 10% and it's reciprocal, think about the savings.
Could the world walk away? Could we walk away from the entire system? Do we really need tariffs other than to protect maybe some real key national security concerns?
Well, I'm a supply center, so I'd say no. I live in a state with no income tax, so trust me, I don't like tax.
Rub it in. We're in New York and Connecticut over here, so thanks.
That's right. I'm in Nashville, Tennessee, so but I'm a native Californian originally. I'm a tax refugee. But yeah, I think what the goal be is, I think you're going to have some tariffs. You can't get rid of all of them, but at the same time, if you can lower the complexity and lower the absolute rate, you cause the fewest number of distortions in behavior. So you don't get this gaming of like, hey, we're going to ship steel to Canada and Mexico, then import it in, it came from China or Russia or wherever. Those games kind of stop, which is really what you want. You want markets to kind of, and industries to kind of just figure out who can do things the best.
Arthur, I'm going to give the president credit. I will entertain the possibility that this chaotic strategy is actually the strategy. But I want to ask you, and I want to get back to capital accounts. I think that a lot of people like me who are not professional CFAs or even have finance degrees, we tend to think of tariffs on the one side, the trade imbalance and the trade balance numbers. But what I threw out at you earlier, capital account, what we forget is, yes, we may have a trade imbalance, but I think the analogy I heard was, I've got a trade imbalance with my barber. I don't get anything except a haircut. That individual gets the money. Capital accounts, on the other hand, is the flow of money into the United States. Yeah. And if we were to go to, I'll just say for the discussion, no tariffs, I mean truly open trade, would that necessarily be a net positive for the United States, or would it be a problem? Because it's a lot cheaper to make sneakers in Vietnam than it is in the United States.
So I guess, like everything, it depends. So
you sound like you're from Goldman Sachs.
I don't know that I'd change my answer tomorrow, but I would say, look, at tariffs are taxes. Taxes, in my view, distort behavior. Taxes are bad. They're necessary, but they're bad. So if you're going to impose a tax or a tariff, again, you want to have lowest level and on the broadest base. So you distort behavior the least, right? You cause the least amount of damage. But it's funny, a trade deficit and a trade surplus, this is accounting. It's double entry accounting. So if we're running a trade deficit with someone, then the other question I would ask someone is, what's on the other side of that equation? Well, it's a capital surplus. And let me ask you a question. Would you rather have capital lined up on your border trying to get in or out?
Great question. I know how I'd answer it. I want it in.
When we have good policies in the United States, capital wants to get in. It wants to buy U.S. located assets. How does it do that? Run a trade deficit. We run a trade deficit with the world. They run a trade surplus. They try to import. I
think that's been great for assets here in the United States and the asset owner class in the United States. But I think what President Trump's trying to do is speak to that segment of the population that got left behind with all that. And that clearly exists. And there was also some national security concerns that we kind of witnessed during COVID, where we suddenly found out that we weren't manufacturing anything. Yeah. And that some key things that we needed just to survive as a nation, we were reliant on, an avowed, what other word can I use but an enemy?
This is going to go to both of you. I'll start with David, though, because all of us are, I'm older than you, Arthur. I'm probably about the same age as David, although he was in the rock band. You might be a year or two older than me. David really was in a rock band. That's another story. But here's the deal. We grew up in an era of globalization, free market capitalism being exported to the world. And as David just pointed out, we sacrificed a great deal. David, you first. The strategy at hand is blow it all up now and fix it. But is that realistic? Because, a lot of millions of Americans got hurt as we globalized. But do two wrongs make a right? Do we hurt millions of Americans to fix that in the process?
Yeah, we do. And that's the unfortunate thing, because, if what President Trump is trying to do is the art of the deal, and this is a grand negotiating scheme to get people to come to the table, because tariffs, they're an economic weapon, and they're gamed. And we saw China come into Mexico and game the entire, system. If that's what it is, then I kind of endorse that. But if the goal is to end up with some kind of revenue generating large tax, ultimately that's self-defeating, because you start to protect an industry and it becomes very inefficient, and there's no competition, and mankind does not advance. So there's a balance here somewhere, and it's above my pay grade, but somewhere out here is the right balance, and I hope we can get to that.
Arthur?
Yeah, you're right. So go back to the late 70s, early 80s under the real President Reagan. You had protectionist policies protecting U.S. steel, autos. Remember Lee Iacocca, Buy American? Mm-hmm. They make crummy products. Why? Even the airline industry in the U.S., hugely regulated. And to David's point, became really inefficient, overly protected, didn't innovate, didn't reinvest. Why? Didn't have to, right? So high tariffs are definitely a game that destroy companies, they destroy sectors, they destroy industries. So that's a non-starter other than for national security purposes, 100%. That'd be one of the few things. You go back to David Ricardo, gains from trade. That's important stuff, but national security trumps everything. You want to have the lowest tariffs possible. Like, again, it's just like it's any tax. It's like an income tax. It's any kind of tax.
So
if you're going to impose them, keep them low.
Well, I'm going to, as we wrap this part of the discussion up, let me ask you about this, because I lived in Cleveland, Ohio for several years. It's one of my favorite cities in the country. I was there when LTV went belly up. I was there when it was middle steel at one point. A buddy of mine lost his retirement when LTV went up. I can't imagine them expanding that steel mill after they shipped, by the way, the facilities to China. This was the stuff I covered as a reporter 20 years ago. But even with tariffs in place and the United Steelworkers are supporting all of this, I don't see that stuff coming back. Do you, Arthur?
I mean, if we subsidize it, it will. I mean, so the president really wants shipbuilding. I mean, the government demands shipbuilding. We're going to get shipbuilding. If the government demands steel manufacturing in the United States, they can subsidize it. I mean, you can bring it back, no problem. And you can bring it up pretty fast, probably. But, speaking of Cleveland, my dad's from Cleveland. My grandfather ran Clevite, which got by gold. And, he didn't retire with a lot of money. And he was a CEO of the company. He went from the stockroom to the CEO. Industries that get protected and that don't innovate or can't reinvest and really become better companies, from a corporate standpoint, they don't tend to do well. Dave, and we can protect them, but
I'll take on to that. But the divining rod might actually be AI and robotics. It might be the way for us to compete in the real world at the manufacturing level. We don't know yet. But that's the hope of what AI can bring us as it translates to the entire industrial complex.
So this is the last question for both of you. I'll start with David. We'll finish with Arthur. David, Thursday morning, I'm sure your clients are calling, and I'm sure your strategy was not sell and panic and then lose when the thing the rise back up.
I came close.
Okay. Well, honesty, you can testify. What are you going to do tomorrow? How do you plan when it's as if this is really chaotic? There's no foundation.
It is, and we have not fixed the market. Even coming into this, there were cracks in the market before all of the tariff stuff. DeepSeek moment was very, very serious. It showed that we were overinvesting. We were already rich, and with interest rates where they were, Warren Buffett isn't stepping in here. Where Warren Buffett would step in is probably about 15%, 20% lower than where we are right now.
Arthur?
Wow. That's great, David. Thank you. I'd say some version of the same thing. Professional money managers, it's, keep calm and carry on, focus on fundamentals, stick to your process. If you see a company you really like, has good management, good earnings, they're going the right direction, they're in a sector that's the right place, like AI, you stay the course, prices come down. If you have cash, redeploy it, dollar cost average in. Don't look at your statement every day. I tell all my friends that I'm like, don't look unless you're going to do something.
I'm going to throw everyone for a loop because there's a question that came in from Courtney, who's on X, that I do want to get this one in. And it's Courtney who's asking a question that I think a lot of us who are novices want to know. And Courtney writes, I'm 30 and trying to grow my Roth IRA. Good for you for having the Roth. I did that years ago. With today's record closing, should I invest now or wait for another drop? David, you take that one first.
I think Arthur said it, dollar cost average in, because none of us really know where the bottom is. It's a process and it'll unfold over time. It's not a price. It's really a process that has to take place. I thought Arthur said it perfectly.
And then let's pull up this question coming in from Paul. Paul writes, if you impose the tariffs with China, 125%. I think of that movie, The Producers, the Mel Brooks version from the 1960s, where they sell 2,000% of the investment in the show. But 125% tariff on China. So America can have produce. So America can produce the same items now imported. Wouldn't it take 3+ years to make that change? And wouldn't businesses want a stability before committing the dollars? Arthur, you take that one.
No, they make the change right away. They can impose the tariffs right now. In fact, he did. He imposed the tariffs 125% effective, I think, tonight. So they spent a lot of time. This is one of the, if you noticed early on, they had a hard time with the de minimis amounts, $800, it was under $800. So they're shipping stuff through the Postal Service. They fixed that loophole. So they are actually hitting them with 125% tariffs, I think, effectively tonight, starting tonight.
All right. And because I pay for the bills around here, I got one last question for Arthur. You mentioned that your father was from Cleveland. East Side or West Side? This is an important answer.
Shaker Heights.
East Side. Yes.
Yeah.
For my West Side friends, I'm sorry, Strongsville, I love you, but the East Side is where it's at. Arthur Laffer Jr., really appreciate your being here. It was a pleasure. I hope you'll come back, and make sure you can check out Arthur, host of Macro Micro Moment, every Wednesday at 5 p.m. They stream across several platforms. Again, the show is Macro Micro Moment. And if you want to learn more about Arthur, he is the president of Laffer Tengler Investments. It was good to see you. David, stick around. We have some more questions we're going to get to after this. We're going to take a quick break, and we'll be right back.
Thank you.
Welcome back to Talkenomics Live. I'm Adam Shapiro. David Nelson, who is the chief strategist at Bell Point Asset Management, is back for his second turn at the program, and it's good to have you here. We have a question from the Geiserman Group. And by the way, I know the Geiserman Group. If you need PR, you want to speak to Lou Geiserman and his team. But this question is pretty important. What they're asking is, so Trump is increasing tariffs on China. Might markets realize this tomorrow, that China will put pressure on Apple and other key businesses and stocks just sink again? China is key. David, that question is directed to you. What do you think? And then I'm going to introduce everybody to David Montgomery.
Yeah, China has weapons. Make no mistake. This is not over. They can come out and they can significantly devalue their currency. Some have put it out. I actually heard a program that made a lot of sense. They already infringe on our intellectual property, but they could go to the max. They could start selling software, violate the intellectual property, sell Microsoft Word at $5. They could do those kind of things and disrupt world markets. So this is not over.
It is a trade war. That is the setup. I joke with our next guest that nobody's ever died on Talkenomics. Let's keep it that way. But our next guest, as we enter into this trade war with China, is David Montgomery. Let me tell you a little bit about David, because when it comes to retirement, a lot of us think about our personal accounts. But what David does, and he is a respected individual, he is an award-winning fiduciary, he creates the plans that your employer or that employers might need to be created. So people like us who work for companies can have 401ks or can have defined benefit plans. So David Montgomery is joining us. He is the managing director of retirement plan services for Concurrent. And David, it's a pleasure to meet you via video.
Truly a pleasure. Thank you so much for having me, Adam.
You know, in a discussion like this, after what we're watching in these markets, I realize that you're not focused on the individual investor. Your work is, because the plans you create are about the individual. But as you're creating these plans for your clients and you see this kind of volatility in markets, what kind of questions are they asking you?
Yeah, so there's a variety of questions that come in, and you're exactly right. My direct client and people that I work with is the institutions, the employers, the HR directors, the CEOs, business owners, a variety of different people. And the end user is definitely all of the employees and the individuals. And that's where we craft everything in a way that makes the retirement plan, such as a 401k, a very attractive place for employees to actually save for retirement and hopefully save enough for retirement so they have the lifestyle that they want. And so questions that employers are asking us right now revolve around a couple of key things. One is, with volatility like this, has my liability gone up in running the plan? Most people don't realize it, but the employers that run these 401k plans and other retirement plans are very, very liable for all of the decisions that they make in running that plan. And another big one is, what should I do right now? Should I do anything? The markets are going crazy. They're up and down. Employees may or may not be coming to them, asking questions, freaking out, hopefully not freaking out. But that's a big question, is what should I do right now? And then secondly, what should we be telling our employees, especially if they have some of them that are a bit concerned about the market? A lot of people, especially in the last, say, 5+ years, really look to their employers as a place that they can receive, or should be hopefully receiving, some kind of financial assistance from somebody. Not necessarily the employer directly, because they're usually not experts in the field, but having somebody like myself or my firm or other individuals be able to help them with retirement and saving questions.
David, you got a question for David Montgomery?
Yeah, I do. You know, over the last decade, diversification was a dirty word, because all diversification did was dilute the amount of money you could make owning the S&P 500. Suddenly, diversification over the last number of months has started to make sense. International markets, maybe some bonds. Those guys ended up doing better than the all stock guys. Over the last 10 years, have everybody swung over to the equity side, or is the average investor in a 401k overexposed to the market given their age?
You know, that's a really interesting question there. And in a lot of cases, yes, people that are trying to create their mix of investments, their asset allocation themselves, typically it's not an appropriate asset allocation, and they are heavily equity into equities. That's where, thankfully, in 401k plans, there's a type of vehicle that has helped individuals that aren't necessarily investment savvy, or even those that are, really make that asset allocation decision a lot more simplified, and prevents them from being overly allocated to equities. And there's a couple of different key ways. One big way, which about 80% approximately of assets in retirement plans go into these nowadays, and that's something called a target date fund. And that's where, or TDF for short, and that's where there's a professional money manager that actually creates that asset allocation at an appropriate risk level in equities versus bonds and all of these sub-asset classes for somebody retiring in XYZ date. These typically go by 5-year increments, so like 2020, 25, 30, 35, and so on. And so a lot of employees are actually in those now, which is a sigh of relief to employers, because they know most people should hopefully not have an over equity exposure unless they go into it themselves and do it improperly.
So for the people who are watching us right now, if they are in, I think it's something like 50% of working Americans have access to a 401k plan. Mm-hmm. If they're in a plan, but it's a very, nothing special plan, which is really just offering them index funds, how do they approach their employer to then approach someone like you to say, we need a better plan?
That's a great, so really they just start off exactly like what you're saying there. They just approach their employer. They talk to their HR director usually, and just find out more about the options in the plan. they should specifically say if there's something that they're looking for. A lot of times those questions are spurred by maybe an article that they saw about something, say advisor managed accounts or a retirement income solution or some other kind of a feature, or maybe one of their friends that says it. But going to their employer and just saying, I'd like to understand this more, and I think this should be designed a little bit better. Amazingly, because employers design these plans with the features that are in there, they have can have a dramatic impact on people's retirement savings and thus retirement lifestyle, just on the basic decisions that they make. So they've actually got a pretty big responsibility in directing people's retirement lifestyles. And then with those, so some employers don't always have an advisor or somebody professional helping relieve them of their liability, and not just relieve them of their liability, but actually help them in the different features of that 401k plan. So if they don't have one, then they can go out and do a search.
So I'm gonna throw this question to both of you. I'm going to start with David Nelson on this one. David, I'm curious how you feel about annuities for people who are, let's say, approaching retirement and they've got substantial funds. Should they perhaps consider a portion, not everything, but a portion for an annuity?
I could go for a portion. My problem with insurance contracts, because that's what an annuity is the embedded fees in them they're rich. They're really, really rich. And once you're in these things, you're pretty much locked in. It's not like you can change your mind the next day. The cost to get out of an annuity is enormous.
David Montgomery, but those annuities are part of the 401k plans and the retirement packages that you're creating for people. What do you say to David Nelson?
There's different types of annuities out there. So I would say that the annuity in, say, a personal IRA or non-retirement, non-401k account is going to be a different kind of approach and fees than, say, an annuity within a retirement plan. So I'll call it an in-plan annuity. And actually, these are growing pretty rapidly in the 401k environment since a few things changed with some legislation, the Secure Act 1.0 in 2019, and then Secure Act 2.0. And they do have some fees definitely involved in them. So they're a little more expensive than just your regular mutual fund. But they aren't quite as restrictive like they are outside of a 401k plan. And a lot of these retirement income solutions are actually being designed in a way where they're pretty flexible. Where I would definitely agree also with David, not 100% of your portfolio should be in that kind of an account. Yeah, but a portion. And it's interesting because actually across the country, when there's a lot of surveys being done on this, people are looking for some kind of guaranteed option within the 401k plan. There was actually some interesting studies done as well where probably some of what David's thinking there too is the word annuity a lot of times has a negative sound to it. People are like, oh gosh, I don't want that. These have been, poorly sold, improper things, high fees, all that kind of thing. And but in these studies, they've been talking about the broad term of guaranteed income. And when they use the term annuity, people are like, oh gosh, I thought you liked me. Why would you be doing that to me? I thought you're my friend. But then when they just use the term of, say, defined benefit plan or pension plan, another form of guaranteed income, like, oh yeah, I would love that. And so just a change in the word. And so why I say that is in the 401k industry, they're shaping these retirement income solutions to be more defined benefit like, but in a more modern way, cleaned up.
It's a word I haven't heard in a long time, defined benefit. It seems to have gone away.
It just useless trivia here, but I think it's only 9% of the working age population has access to what we would all call a traditional private pension.
Right. Yeah, it's very, very small. The defined benefit plans are a dying breed. But that's where, as time goes on, we're able to take that concept of defined benefit plan, because that's how things were before 401ks existed. Then all of the responsibility for retirement savings was now put in employees' hands to save for themselves, try to figure out, how should I be investing? Some of them are way too much in equities, like David was saying earlier, or way too conservative. And then how much should I be saving? Big question. And that's where employers have a big responsibility in what they do there. And so DBizing, or defined benefitizing, the 401k plan with retirement income solutions is a growing trend, and really around the globe, actually, with these kinds of plans.
So David Montgomery, let's wrap up. Two more questions for you. The first, We talked about the volatility that has everybody on edge. I'm curious, when you speak to potential clients about building these plans, what kind of questions are you anticipating, given that what we used to all just sleep on as a done deal is no longer a done deal, and I don't think many people are getting much sleep. So what are the questions you're anticipating as you go forward from your future clients?
Sure. Future questions are around how might we help reduce the volatility of the investments in the plan. As we were talking about a little bit earlier, you can be all in equities and asset allocation. Maybe was a dirty word the last 10 years, but now with more volatility, people are realizing that, okay, I would maybe like some active management to hopefully reduce some of that downside risk. So that's a big component of it. Also, from employers, what are the fees going to be like? That's a very, very, very common one. And how much of my day-to-day whirlwind can you offload from my plate? People are busier than ever and stretched more and more thin. So that's a big question they look for, is how much can be offloaded in addition to the liability and running the plan, because people just don't want it.
Okay, and the last question for you, it's Adam Shapiro's geography tour of the United States. You're joining us from Tampa, and you and I talked about the Columbia, which is this restaurant that's been down there for over 100 years. Do you get the salad or do you get the black beans and rice?
Ooh, both.
Okay.
I like to eat. Both, really, honestly.
All right, it's the they call it the 1902 salad because they were founded in 1902, right?
That's yes, that's correct. Yeah.
All right, David Nelson, you ever been to Tampa?
I have, but it's been a long time. The last time I was there was with the Turtles.
Your rock band, right? All right. David Montgomery is the managing director of retirement plan services for Concurrent, which he's in Tampa, Florida. You can find him on LinkedIn, and we really appreciate your being here. Thank you for joining us.
Thank you so much, Adam. Appreciate it. Thank you, David.
When we come back, we have got two men on deck who launched something that small business owners, that companies that are looking for a break should get ready, because the capital markets, it's as if they're closed off to people who just want a fair shake. And that fair shake could be coming this year. When we come back, you're going to meet the founders of Dream Exchange. Welcome back to Talkenomics Live. I'm Adam Shapiro, joined by David Nelson, the senior strategist the chief strategist at Bell Point Asset Management. We have two questions before we get to our next guest. And first, thank you, Julie, who pointed out it's not the 1902 salad, it's the 1905 salad at the Columbia down in Tampa. But I want to get to this question from William Montgomery. And I apologize we didn't get David Montgomery on this, but the question is, how do the new 401k retirement income features address longevity risk for retirees? This is still something that you have to deal with your clients, David. How do you, we're living longer. So how do you address that?
It's a challenge. It's a real challenge. But I think what we're going to have to get used to the idea of we're going to be working longer. You know, when you think back to when FDR came up with Social Security, the average life expectancy was 57 years old. It was a done deal. Nobody was going to collect. Here we are living, many of us are going to live, well past 100 because that's where, healthcare is going at this point. So we're going to have to come up with solutions to, make more money. But I think the answer to this is that most people are going to retire at a later age because they're going to be vibrant. They're going to want to do something. Their retirement years are going to be not from 65. It's probably going to be from 75 on.
I'm thinking of the sci-fi movie from the 1970s, Logan's Run, 30 and you're out, but that's a whole other story. Real quick, one more question. This one is coming from Betsy. And Betsy was asking, why put such a shock to the system when we already have inflation? Also, our agriculture industry is subsidized by the government, so would it follow that countries have imposed tariffs in response? And are tariffs put in place to protect jobs? If so, isn't it up to the employee to develop skills that will match economic growth? David?
Absolutely on the last part of that. We're all going to have to change. And certainly AI is going to force us to change because a lot of the tasks that we're doing right now that humans are doing, AI is going to do. And I think our job is to evolve. It's been that way since the beginning of time. Every industry has been disrupted. No industry is safe. So you're going to have to keep studying. You're going to have to address that. As far as the shock to the system, we have a lot of problems and sometimes you do have to shock the system. I think this could have been done in a better way. I think where President Trump needs to adjust is he has to give President Xi a golden parachute. I would not humiliate him. You've got to give him a way to agree, but at the same time save face. And that's not being done right now.
You brought up change, and that's a perfect way to segue into our next two guests because they're bringing about change. It started in 2015, so 10 years ago when they founded Dream Exchange, the change began, and this could be a pivotal year for an exchange that will allow the small guy, I'll say. I mean, the language of guy is supposedly sexist, but the small guy, the small gal, to generate capital and have opportunity that has been closed off to people who have companies that the larger market makers and exchanges won't give any time of day to. So let's bring in Joe Sikela, the founder and CEO of Dream Exchange, along with Dwayne Kiles, the managing member of DX Capital Partners. We appreciate both of you being here. And Joe, I'm going to start with you because having done this as a financial reporter for 20 years now, I've seen how the lack of capital can kill a really great business. Where did you get the idea to launch an exchange, and what are the hurdles you face in doing that?
Jeez. So first off, I'm so glad to be on a podcast not talking about blockchain and cryptocurrency right now. Have a party. And thank you for having us. But so the idea for the Dream Exchange actually came from I was a lawyer for the founders of Archipelago in 1995. So that was really the first electronic platform that was, creating what we now know as best execution, best price. And, I was a capital raiser for many, many, many small companies, but I really discovered that the notion of an exit for a business to the public capital markets had died. And it really died somewhere around 2005, 2006. So I started doing a lot of research, and I realized, going back, I really enjoyed your first two segments because the real asset that the country has is its ideas. We're the greatest innovators and most imaginative people on the planet. And what we have to do is restore a public capital pipeline to the emerging companies that have the best idea really do become the fabric of our country. And this is not a new problem. It's been around for about 25 years. We don't really publicly finance our small caps. So this is where the idea came from. Dwayne has been my partner for 21 years and lawyer, and we worked on all these small businesses, and really that exit is extremely important to have the hope of a public liquidity event. And that's what we decided to do in building the exchange. Obviously, we've built a national market.
So, and Dwayne, you recently applied with the SEC for, I don't know the right terminology, but I guess for licensing to be a nationwide exchange. That process.
That's correct.
How important is it to gain that? I would imagine it's the key to success here. And what is the likelihood you'll get the go button within the next few months?
Well, you're right. It is absolutely necessary. In order to be a stock exchange, you have to be licensed by the SEC. And this has been a long process, as you have alluded. We are hoping that we'll be able to make sure that people who have long had great ideas, have worked hard, done everything that they were supposed to do to realize the American dream, but have generally fallen short because of their lack of access to the relationships and the resources that come from the capital markets and the infrastructure that supports it. These folks will, have had a very hard time getting access to the capital. The public capital markets are the answer. They're what built America. And to the extent that we have now, we will make access to those resources available to people who have small and mid-cap companies, it will be extraordinary. And we do expect that it will happen sometime this year, for sure.
David?
I knew nothing about this, coming into this show, Adam, and this is a fabulous idea. I do a lot of direct indexing, so I know the drain on the number of companies that are out there trading publicly today are so far less than what they were. You look at some indexes that were supposed to be 3,000 or 4,000 companies, and they're down to 2. So we need this. I guess, Joe, I'll put the question to you. The question that I would have is the due diligence involved here, and also the education process for the investors to look at these companies. How do you manage both sides of that? Because it is an issue. You want to make sure that that people on both sides of the equation are protected here.
Yeah, that is the ultimate question. It's not just that you've got somebody who's got a great idea. It really is a market education. I mean, here we are. It's a market educational process that we're in. That's actually one of the entire phases of our strategic plan, because small caps have an entirely different marketplace. We've actually worked on a piece of legislation called the Main Street Growth Act, which is working its way through Congress. It actually passed the Congress unanimously in 2018, and had we not shut down the government, it would have been the law. And it creates a new type of exchange called a venture exchange. Now, that's got a bad word in most countries, but in the United States, this legislation it's a brand new type of exchange. And our primary job, is educating not only the asset allocators and the large asset aggregators, pension funds, and 401k plan management into how to use this new type of market, because it does dovetail into asset allocation. It does give people something that we as an exchange have undertaken a tremendous amount of complexity in the application and due diligence process. So you're getting a really vetted company before it can reach a public market. And we haven't changed any of the requirements that go along with, public market registration. So the good news is it's small, but it's a high bar. So we only want really quality companies. That's the educational process that needs to come in. I'm actually on the board of the University of Wisconsin's Lubar College of Business. We're actually doing a curriculum. So we have a Dream Exchange professor of finance at UW Milwaukee, and there's an entire curriculum. It's a brand new industry about to be born. So the educational component is going to be really done through a lot of resources we're dedicating to making sure the market understands the difference between, a high volume, high arbitrage, perhaps a dark pool marketplace, and this other marketplace where, you saw the Russell 2000 take a major hit and a recovery. They never went below their 52-year low in the last week. But, they're in a marketplace where, 2 billion shares trade in 1.64 seconds every day. So the small caps do not thrive in that environment. So we're segregating out that marketplace in a way that will allow true investing and keep companies listed and keep them growing. NVIDIA, they were almost delisted by the NASDAQ 7 years ago.
I remember that.
So what you have to look at is, what's the idea? What does the company really have? Not only do they have, plant and equipment, but what's their IP? What is the thing that is going to make that company extraordinary? And we're really trying to reach Steve Jobs in the garage. We want to reach that company at its earliest possible stage, and in communities and environments that, perhaps other exchanges are not willing to go. It doesn't make them a lot of money. Let's just say it.
Do you have, real quick, if you get the yes from the SEC tomorrow, do you have companies that are saying we're ready, let's go? Are you talking to companies that want to go public?
We are, and what we're doing right now, actually, this is going back to the point, is we're not just assuming we're right. So there's about a 9-month process we're in right now, which is a bit of survey of the membership and survey of investment banks and survey of how they may view underwriting and investing in this marketplace. Because we have companies, we have some extraordinary technologies and individuals that have, some companies are approaching $1 billion in annual revenue. They're not interesting to the public markets right now by virtue of the fact that they might not be a multi-billion-dollar IPO. So, the market shifted from the number of deals it did per year. We were doing 700-800 IPOs per year, up to 2,000. Then, with the advent of high-speed electronic trading, we were doing less than 200 a year. And most of them grew in size, but the important part was they grew in share volume. So we shifted the revenue model in the banking world and in the exchange world from number of deals done to number of shares traded.
Gotcha.
So this is a new market where number of deals done, we're actually able to restore a revenue stream to the underwriters, investment banks. We're making it really economically sound to take a small cap public on our exchange so that we can grow the number of listings that are available for the day-to-day market to asset allocate to. We only have about 6,000 listings, and 2,500 of them comprise most of the trading in the market.
On that note, we wish you the best. We're going to let everyone know when you get that SEC license. Want to thank Joe Cicala, the founder and CEO, as well as Dwayne Kiles, the partner from Dream Exchange. Again, wishing both of you the best, and anything that helps small businesses get a leg up and raise capital is a good idea. And I got to thank David Nelson, who, once again, it's great to have you here, David, and I'm looking forward to the next time we get to do this on a less volatile day, because riding the tariff tsunami, I'm at the age where I don't think my heart can take it. But thank you so much for being here, David.
Thanks for having me, Adam.
And thank you for joining us for Talkenomics Live. We stream live every Wednesday at 7 p.m., and you never know what's in store, especially with this administration. One day it's something else. So we will see you in a week.